This is one of the absolute best scalping strategies you can ever get your hands on. And the best part? You don't need a single indicator. We are stripping everything away and relying purely on price action and market structure. I'm going to break down this entire strategy for you from the very beginning to the very end, so please, do not skip a single second if you are truly serious about mastering this method. For this specific strategy, I'm using the 5-minute time frame to actually execute and enter my trades. But before we even think about clicking buy or sell, our absolute first task is to clearly identify the direction of the trend. To do that, I always zoom out and head over to the 1-hour time frame. This allows me to gauge the overall momentum of the market and see the bigger picture. Is the market moving up, sliding down, or just moving sideways? Now listen to me closely on this. You need to focus entirely on what the price is doing right here, right now. There is absolutely no point in looking at price action from all the way up the chart, or digging back into historical data from 2008 to see what happened. That data is completely irrelevant to us because we are day-to-day scalpers. We only care about current momentum. Looking at this chart right now, you can clearly see we are in a textbook downtrend. The market has been consistently making lower highs and lower lows, just steadily printing a path downward. On top of that, price has just made a major retracement. That is our very first clue signaling a dominant downtrend. If we zoom in a bit closer right here, you'll see our second confirmation. Price has just broken straight through the last higher low. In technical terms, this is a clear break of structure. Remember, market structure is everything. If you haven't watched my dedicated video on market structure yet, make sure you go watch that right after this one ends. Since the market just broke that previous higher low, my game plan is to wait for the price to pull back up, retest this exact level, and then reject it to shoot right back down. With that roadmap in mind, it's time for me to drop down to the 5-minute time frame to hunt for my precise entry. Once you are down on the 5-minute chart, your eyes should be glued to the screen waiting for that retest. To recap the foundational steps, you identify the macro trend direction on the 1-hour chart, determining if we are trending up, down, or consolidating, and you watch for those crucial breaks of structure where price snaps past previous highs, lows, or pullbacks. And again, keep your focus strictly on immediate price action, not what happened weeks ago. Let's dive deeper into what a break of structure actually looks like on the lower time frame. Once you drop down to the 5-minute chart, you are actively tracking the breach of recent highs or lows. To make this easier, I'll grab the trendline tool or a simple horizontal line tool to map out the recent boundaries. Here is our recent low, which corresponds to that last higher low we spotted on the 1-hour chart. And up here is our recent high, representing the highest point the price has tag marketed recently. The reason I marked this specific level as the previous higher low becomes obvious when you look to the left. You can see the market climbing, creating a clean rhythm of higher highs and higher lows before it pushed up to tap that absolute highest peak. That makes this specific spot our most critical, most recent higher low. Right now we are playing a waiting game. We want to see how price reacts to these boundaries. From here, 2 potential scenarios can unfold. First, price could break past the recent high and continue upward. If that happens, we patiently wait for a pullback to that broken high and enter a buy position. Second, price could break straight through that last higher low, pull back up to retest it as resistance, and then roll over. That would be our cue to enter a sell position. Those are your only 2 choices. You either buy the high break or sell the low break. Let's watch what the market does next to see which boundary gives way first. As the candles print, you can see right there price just broke cleanly through the last higher low. Now, do we just blindly jump into a sell trade the moment it breaks? Hell no. We have to wait for the price to pull back up to this broken level and give us a definitive confirmation. That confirmation is our insurance policy. It proves to us that this is a valid downtrend and that the market is truly ready to head back down. Sure enough, look at the chart price is starting to pull back up toward that previous higher low. Now that the pullback is happening, we wait for our candle confirmations before executing. If you are looking to short the market, you want to see specific rejection signals, like candles with long upper wicks, or strong bearish engulfing candlesticks. On the flip side, if you were looking to buy, you'd be hunting for long lower wicks, or bullish engulfing candles. These high momentum candlesticks are crucial because they visually prove that institutional orders are rejecting that key level and are ready to push price back in the direction of the overall trend. Right now, price has tapped the higher low, but hasn't given us that momentum candle just yet. So we continue to sit on our hands and wait. And there it is. Right here, the market prints a massive bearish engulfing candlestick. That is our undeniable signal that the price is heavily rejecting this key level. I'm entering a sell position right at the close of this candle. I'll place my stop loss safely just above the wick of this bearish engulfing candlestick. For the take profit target, we are shooting for a strict 2-to-1 reward to risk ratio. I literally just click and drag the take profit tool down until the ratio metric reads exactly 2. This means if you are risking $100 on this trade, you stand to make $200 if it hits. Let's play the tape forward and see how this trade unfolds. Look at that momentum. The price aggressively drops right out of the gate and absolutely smashes our take profit level. Just like that, team, the first trade is a wrap. Once your take profit gets hit, you don't get complacent. You immediately reset and repeat the exact same process. Pull out your line tool again and start marking the newly formed highs and lows. Right after that drop, the price hasn't established any clear or valid structural levels yet, so we don't force anything. We just wait. If we pop back up to the 1-hour time frame to see where we are in the grand scheme of things, you can see price is rapidly approaching a major low. This is a historically massive support area. You can see based on past data that every single time price hits this zone, it violently bounces back up 1, 2, 3 times before. Knowing we are sitting on a heavy higher time frame support zone, we can expect a potential bounce. I'm going to clean up my chart by deleting the old trade metrics and removing the previous resistance line since it's no longer relevant. Now, our entire focus is locked onto how price behaves inside this major support range. We watch and wait to see what kind of confirmation the market gives us here. The candles keep printing and you can see the price has traveled all the way down into our projected support zone and is starting to stall out and consolidate. This is my cue to drop back down to the 5-minute time frame to look for a micro break of structure. Once we look at the 5-minute chart, it becomes clear that price aggressively tested that macro support line we drew, swept it, and then instantly snapped right back up. Let's map the local structure here. We can mark this recent high right here. Notice how price just broke clean above that previous micro high and is now coming back down to retest it. The moment it dips back into this retest zone, we are on high alert for our buyer's confirmation. Look closely at what happens next. The market prints multiple candles with long lower wicks right in a row, followed by a beautiful textbook bullish engulfing candlestick. This is a massive telltale sign that the bears are exhausted. Buyers are stepping in and the price is gearing up to reverse back upward. I am pulling the trigger on a buy order right here on the close of that bullish engulfing candle. My stop loss goes safely right below the lows of those rejection wicks, and my take profit is dragged up to hit that exact 2-to-1 risk to reward mark. Let's see how the market handles it this time. Boom! It rockets straight up and absolutely obliterates our target. That is our second massive win locked in the bag, clear as day. What makes this strategy so incredible is its sheer versatility. This exact scalping system works flawlessly whether you are trading gold, the US 30, crypto, or forex pairs. It works universally because it is rooted deeply in the core mechanics of market structure, and market structure is the fundamental reason why price moves the way it moves. The market naturally flows through these structural phases, and price is forced to respect these levels. Let me switch over to gold to show you how beautifully consistent this is across different assets. Looking at the gold chart, you can see price had been locked into a clear downtrend. But look at this specific turning point, right here. Price breaks right above the last lower high. Up until this point, gold was just printing lower highs and lower lows sequentially. This breach of the final lower high is our early warning system that the bearish structure is failing, and the market might be reversing into a brand new uptrend. With this shift noted on the higher view, I'm dropping down to the 5-minute chart on gold to map out my immediate boundaries. We see a clear recent high, price breaks through it, pulls back, and then starts printing a sequence of higher highs and higher lows on the microscale. Let's draw a line right at this local higher low. This is our line in the sand. Now we wait to see how the market reacts. As we watch the price develop, it ends up breaking below that micro higher low. Now we flip our bias and wait for the price to pull back up to that broken level, so we can short it. The market moves back up, and right at the retest zone it begins printing candles with long upper wicks. Remember, those long upper wicks are exactly what we look for to confirm a short entry on a pullback. I'm jumping into a sell position right here. Stop loss goes right above that rejection wick, and the take profit is set to twice the distance of our risk. Let's roll it forward, and just like that, price slides down and smashes our take profit target perfectly. Once again, the moment the trade hits the target, you clean up your chart, delete the old analysis lines, and map out the new structural points. We have a fresh lower low formed, so we sit tight and wait for the price to pull back up into this area to give us another sell setup. We wait through several candles. It pulls all the way up to our level, but it isn't giving us a clean bearish engulfing candle or any significant upper wicks yet, so we don't touch it. The market starts consolidating and grinding sideways right around this key zone. Let's speed things up a little bit to see how this consolidation resolves. After spending some time chopping around, the price finally gives us the entry signal we wanted. You can risk an entry right here on this rejection candle, putting your stop loss above the consolidation wicks and targeting a 2-to-1 ratio down below. Let's see how it plays out. Price drifts down, retraces a bit to test our patience, and then aggressively breaks down to smash our take profit target out of the water. We are completely out of the trade with another win. Now looking back at this specific sequence, this played out over a longer duration, making it look a bit more like an intraday trade rather than a lightning-fast scalping trade. If you wanted a visually cleaner, purer scalp entry, it actually happened right over here when the market printed this incredibly sharp bearish engulfing candlestick. Entering right there with a tight stop above the high and a 2-to-1 target would have gotten you out of the market much faster and much cleaner. At the end of the day, this entire profitable strategy boils down to your ability to read, interpret, and respect market structure. It is a mandatory skill that you absolutely must master if you want to become a consistently profitable, successful trader. If you want to dive even deeper and truly master these structural concepts, you need to check out the full-length tutorial video I put together right here, where I teach you exactly how to trade market structure to your absolute advantage. It took me over 7 long, grueling years of trial and error, blown accounts, and endless frustration to finally find the one strategy that turned everything around and made me consistently profitable. 7 years of searching, distilled into a blueprint that I'm about to teach you in under 4 minutes. My routine is sacred. Every single morning at exactly 9:30 Eastern Standard Time, I sit down at my desk, open up my charts, and immediately begin hunting for key price action, hidden within the overnight and pre-market data. My main goal in those early minutes is to map out the battlefield, marking off critical areas of support and resistance, the exact zones where I believe the market is highly likely to stall out and violently reverse. Once those macro levels are locked in, I drop down into a 1-minute chart of that exact same asset. This is where my execution happens, but I don't just click buttons blindly. I specifically focus my attention on the critical window that opens up 30 minutes after the market bell rings. For me, trading the S&P 500, the local open happens at 7:30, so I draw a hard line in the sand at 7:45 and 8 o'clock. Over years of reviewing data, I have consistently noticed that these specific times act as powerful catalyst windows that frequently trigger major reversals in the market. So the moment these time slots approach, I become hyper-aware and locked in. When the clock strikes 7:30 and the market officially opens, I just sit back and watch the raw price action of those first 15 minutes unfold. I am looking for a specific behavior. Does the market aggressively flush straight up, or does it plunge down into one of my pre-marked support zones right as we hit one of those key reversal timings? If the stars align, meaning the price slams into my zone at the exact moment my timing window opens, begins to bottom out, and shows a real spark of upward potential, I start scanning the chart for a few non-negotiable factors before executing the trade. To safely buy a reversal like this, I need to see 4 key factors check out. First, that initial move down into my support zone and timing window absolutely needs to be a strong, aggressive flush. If the market is just slowly grinding down, looking choppy, muddy, and heavy, it's highly unlikely to snap back easily. The best, cleanest trades always happen in volatile, fast-moving markets. Second, the immediate trend needs to be visibly broken. Because I am hunting for reversals, I am essentially betting against the dominant momentum of the morning, which is inherently risky. To do this safely and effectively, I need undeniable proof that the current downtrend is fracturing. To find that proof, I will either draw a tight trend line over the morning's decline and wait for price to snap cleanly above it, or I will closely watch the market swings. I track the highs and the lows like a hawk. The moment the market stops printing lower lows and lower highs and instead establishes a higher low and a potential higher high, that is my ultimate confirmation that the structural tide is shifting. Let me take you through a live look at how this actually plays out on a recorded setup. As the structure shifts, the final piece of the puzzle I look for to complete a beautiful textbook inverted head and shoulders pattern is a massive high momentum bullish candlestick that completely erupts through the local highs. The exact second that happens, I throw my order into the market, betting that the buyers are taking full control to drive price higher. Because I trade strictly in alignment with the natural swings of the market, I place my protective stop loss safely right beneath the previous swing low. When it comes to picking a target, my eye is on the entire origin of that morning drop. When the market flushes down in such a rapid vertical fashion, it creates an incredibly unhealthy, overextended trend, and because of that imbalance, it tends to snap back just as fast. At an absolute minimum, I am aiming for a 2-to-1 reward to risk ratio, though a 3-to-1 ratio is even better. On this specific trade, I watched the price climb, slowly managing my risk and trailing my targets toward those major overhead areas as the momentum carried us up. I ended up closing out the position at a beautiful 2.5 times my initial risk, locking in a sweet profit of just over $4,500.